In these times of low bond yields and market volatility, many investors, maybe like yourself, just might be looking for alternative ways to invest your portfolio. So, unfortunately, individual investors, unlike their big institutional counterparts, are often at a disadvantage when it comes to finding alternative strategies and implementing a more institutional approach for their portfolio. So, how can retail investors gain access to these alternative investments? Well, one way just might be through something called a closed-end interval fund. Closed-end interval funds, or interval funds for short, tend to hold assets that you don't normally see traded in the financial markets, such as private equity, private debt, private real estate, and hedge funds, and are available to individuals without the high minimums typically required when investing in the alternative space. Unlike conventional mutual funds, interval fund purchasers can't sell their shares back whenever they want. Instead, an interval fund will cash you out only a few times a year, most often quarterly. The illiquidity of an interval fund may act as a counterweight to an investor's natural desire to buy when prices are high and sell when prices are low. That can be a good thing because the restricted holding period may buy enough time to calm the fears of irrationality and encourage investors to take advantage of staying invested over the long term. However, on the flip side, you need to be aware of a couple things. The lack of liquidity can be an issue for some because interval funds tend to lock money up in ways that many people aren't used to seeing. For example, some funds allow only 5% of assets to be redeemed each quarter. If too many investors tender shares, their order becomes prorated. The fund could also close redemptions entirely. There are also fees to consider, and they're likely to be higher than standard mutual funds, in some cases 2% or more. But some may feel the additional diversification of alternative investments and potentially higher yields, and due to the illiquid nature of all this stuff, a potentially more stable share price as well, it just might be worth the trade-off. As a result, interval funds are becoming more popular, and new funds, they're just being formed on a regular basis. So it may be helpful to look for those funds that have been around a while. If you're considering adding interval funds to your portfolio, it's important that you pay careful attention to liquidity restrictions, overall fee structure, and fully understand the redemption process and policies. As experienced investors in this space, Lucia Capital Group's financial planning professionals and its affiliated staff of portfolio managers, analysts, and in-house specialists in the area of alternative investments are all well positioned to help individuals like yourself decide whether interval funds are a reasonable choice for added portfolio diversification.
Before investing, carefully consider an interval fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing.